Hey, good morning, everybody. It's 10 a.m. on Tuesday morning. Time for our weekly webinar. I hope everybody's doing well. I'm just getting to the top of my notes here. I was sitting here going through some things. If you're just joining us on YouTube, this is the weekly webinar. So we go over some Slott updates or IRA distribution updates every week that we receive in. And we look at some troubles people are having regarding IRA distributions. A lot of talk about required minimum distributions, whether they're inherited or your own. There's usually a timely report or notice that comes out of that discussion. And there are a lot of good topics this week. I tucked one aside for our next webinar that has to do with the Roth IRA 5-year rule. But we're going to go through the Slott updates, and we're going to spend a few minutes on the market updates, and then we're going to go into our topic today, which is part 2 of 3 that has to do with common Roth IRA questions that we get. And today is about conversions. So this is there are many more. I keep notes when I'm talking to clients, and if we've been in a conversation, often you hear me say I'm just taking a note. Sometimes those notes are. I keep kind of a running list of things I want to talk about on webinars, because you've heard me say this, that time and time again, these the topics come from conversations with y'all, and it's not only existing clients but people from so I get referrals from people from all around the country, whether it's financial advisors, sometimes CPAs and attorneys, and just individual investors and folks looking to set up a tax-free or tax-efficient retirement strategy, or just a solid financial plan. But anyway, we get these questions, and a lot of it has to do because there's just so much information out there. You could spend hours on YouTube or Google and try to piece this information together. And I've just had conversations with folks that have the wrong idea about things, and it might be right about one part of a retirement rule or some type of rule surrounding IRAs, but it doesn't apply to their part. So I hope that makes sense. But what we try to do is give you some references that that you can use that are correct, and certainly a resource. So talking about resources, you can find all these videos not only on YouTube but at our website, which is right up here, Attleboro Wealth. Let me see if I can find it, AttleboroWealth.com. I'm not as smooth as some of these YouTube folks. And if you have questions, you can reach us at questions@AttleboroWealth.com. That's questions@AttleboroWealth.com, and you can reach out to us for questions, or if you want to schedule time with me to go over your particular situation. And again, if you're just watching this for the first time on YouTube, please hit the like, subscribe, and notification button so you're ensured that you get notifications of when our videos come out. So typically it's every Tuesday morning. We'll do a video from time to time. We'll do a special video. Good morning, Doug, with a special topic. We do have a webinar coming up. Let's see when that is. That's our Changing World Retirement Planning class, and that starts on September 28th. So there's 2 Thursdays and 2 Tuesdays. So Thursday evenings are September 28th and October 5th. And then Tuesday is October 3rd and October 10th. And the webinar starts at 6:30 and goes to 9:30. And if you're registered for the webinar, you'll also receive a recording. If you're not, you won't. And in fact, I'm sorry, let me confirm that. If you're registered for the webinar and you attend the webinar, you'll get a recording. If you're registered for the webinar and you don't attend, I can't send you the recording. It's not my material. It's the material from a fellow named David McKnight, who, if you're a regular listener or attendee of these webinars, you know exactly who Dave is. So I can't just share that content widely and like I can do my own. Speaking of Dave, I've been rereading Dave's book. So last week I read The Power of Zero, Tax-Free Income for Life. I read both of those books again last week. And then this week I'm going through again via Audible on Look Before You LERP. And I intend to reread The Volatility Shield. And then I'm going to, my plan is to also reread Ed Slott's book. So I say this to you because it's always good to kind of refresh things. I I think Dave has a lot of great content. I don't follow everything to the letter. Dave and I have differing ideas about things, and you'll see that in Tax-Free Income for Life. We have different strategies around account segmentation and tax guaranteed lifetime income. But I certainly respect what he does, and he brings a great message to a whole lot of people. I think his objective is to help 100,000 people plan for a tax-free retirement, because the word's getting out there. I see more and more advertisements for tax efficient webinars and dinner seminars and things like that, but it's still about 6% of the population has a Roth IRA. And a small portion of those are adequately funded. So we still have a lot of work to do. So there are upcoming webinars. As I mentioned, this is a 3-part series. If you're visiting us on the second part, today is Roth conversions. Our third part will be distributions, and that won't be until September 12th, because next week is Labor Day and we don't have a weekly webinar the day after a holiday. I just can't get the market information I need when there's a market holiday on a Monday in time for the webinar on Tuesday morning. So that's why I skip it that week. But there will be no webinar next week. The next time will be on September 12th. But if you are looking at this webinar, and this usually goes close to an hour long, if not an hour long, the subject should be indexed at the bottom of the description. So you're going to want to scroll all the way down to the bottom of the description, and if there's something you're interested in, you can jump right to that. Or the final part, this what we call the financial 15, which will be the last 15 minutes or so of this broadcast, will be cut into smaller portions. Like last week's discussion around Roth contributions, was broken into 2 videos so that you can listen to them when you're comfortable and when you have smaller periods of time. And you can find those on YouTube also. But on our website, you'll just see the weekly webinars. You have to go to our YouTube page to find the Financial 15s. And if you go to the YouTube page and you haven't already, hit subscribe, like, and notification. Okay. So let's get into our Ed Slott updates. All right. And this is we got this update at the end of the week last week. Well, maybe, I think we got it at the end of the week last week, but it's dated yesterday. So this is from Ian Berger. And this reads, this has to do with the catch-up rule from the Secure Act. So the Secure Act said that anyone making over a certain amount of money had to, and they wanted to use the catch-up contribution provision in their retirement plans, they had to do it in the Roth portion of their 401ks. The problem, of course, is that not everybody has a Roth 401k option. There's a lot more that are available, but not everybody has that. So the plan sponsors and the plan providers were giving feedback saying, we can't do this by January 1st, 2024. We need some help. So let's talk about Ian. Ian's going to tell us how that played out. So last Friday afternoon, August 25th, so I guess we got the notification right after this happened, or maybe I got it over the weekend. Last Friday afternoon, August 25th, 2023, the IRS gave employer plans 2 more years to comply with the controversial Secure 2.0 rule, requiring catch-up contributions for high-paid employees to be made on a Roth basis. The effective date of the rule was postponed from January 1st, 2024 to January 1st, 2026. The delay is set forth in IRS Notice 2023-62. Most 401k, 403bs, and governmental 457 plans allow age 50 or older employees to make catch-up contributions on top of regular elective deferrals. The limit for catch-up contributions in 2023 is $7,500, allowing for total deferrals of up to $30,000. Beginning in 2024, Secure 2.0 requires that certain high-paid employees who want to make catch-ups must have them allocated to a Roth account. So if you're one of those people that say, well, are they going to do away with Roth accounts? Congress is historically trying to push us into Roth accounts. They tried to do that at the last iteration. I guess it was the first Secure Act, or maybe it was the Tax Cuts and Jobs Act. I just don't remember now. They wanted a very limited amount to go into tax-deferred accounts, traditional IRAs, 401ks. Excuse me, just traditional 401ks. And the remainder to go into Roth. So they want those tax dollars now. Let's see. For 2024, that dollar amount would have been $145,000 of 2023 wages. There are several other new Roth provisions in Secure 2.0 involving Roth, SEP, and simple contributions, Roth 401k, employer contributions, and 529 plan to Roth IRA rollovers, but the catch-up rule is the only mandatory change. Some of the country's largest plan record keepers and retirement plan lobbying organizations have requested a postponement of the January 1st, 2024 effective date, citing serious administrative problems with getting the rule into place on such short notice. The effect of the delay until January 1st, 2026 is that until then, no employees will be required to make catch-up contributions on a Roth basis, and plans that don't already have Roth contributions won't need to offer them. The notice also addresses a mistake Congress made when it drafted the mandatory catch-up provision in Secure 2.0. Congress inadvertently deleted a part of the tax code with the result that no employee, high paid or not, would be able to make any catch-up contributions, pre-tax or Roth, starting in 2024. So that was an interesting little twist there. This was an obvious mistake, and the IRS says it will turn a blind eye to it. Notice 2023-62 also says that high-paid self-employed persons who have self-employment income instead of wages won't be required to make catch-up contributions on a Roth basis, even if their income is above the dollar threshold. This was unclear under Secure 2.0. Really great information. So you can still make, of course, your typical contributions if you have a Roth option in your plan, and we've gone over that in previous videos. If you have a Roth option in your plan, you can make your contribution into the traditional option or the Roth option, and you can make your catch-up contribution. What the Secure 2.0 said, that if you're over a certain threshold in 2024, that would have been $145,000, then that catch-up contribution must go into the Roth 401k option. So moving on, this is the mailbag. The age 50 exception and still working exception, today's Slott report mailbag. So this is from Andy Ives, and that's from last week. So here's the question. Hello, I recently came across one of your articles and decided to reach out to you in hopes of getting some clarification regarding the Secure 2.0 Act and this distributions as a qualified public safety employee. In a nutshell, I'm a 17-year career firefighter for a county government. With the new Secure 2.0, it seems as though I can take distributions after 25 years of service or age 50, whichever comes first, without penalty. If this is true, would I be eligible to begin taking distributions at age 57 without penalty? However, I am not eligible to retire from my county service until I reach age 55. So if I separate from service, that is, resign at age 47 with 25 years of service, what would I need to do with my 401k in order to be able to begin taking penalty-free distributions? Any help is appreciated. So you can see Brandon's confusion. And Andy writes, you are correct that any age 50 exception to the 10% early distribution penalty exists for certain public safety employees, including firefighters. Secure 2.0 extended the age 50 public safety exception to private sector firefighters and corrections officers who are employees of state and local governments. Secure 2.0 also modified the exception to apply upon the lesser of age 50 or 25 years of service. So the lesser of age 50 or 25 years of service. If you resign at age 47 and have 25 years of service, there is nothing special you need to do with your 401k. You can take distribution from the plan, and they will be exempt from the 10% early withdrawal penalty. You'll still have to pay tax. This is all about the 10% early withdrawal penalty. Also, do not roll your plan into an IRA if you want to continue to use the age 50 exception. The rule only applies to distributions taken from the plan. That's a great point at the end there, Andy. Next question. If a plan participant is 75 and still working, but they decide to roll over funds mid-year to an IRA for an in-service rollover, does the RMD apply for those funds? That's from John. I'll share with you that I don't think Andy really answers this question. We'll talk a little bit about it, but I haven't had a chance to send him an email about it. It came in last Thursday, I think, this Q&A here. So Andy writes, John, if the work plan includes the still working exception, not all do, and if that employee works through the end of the calendar year, then no RMD applies in that same year. As such, no RMD need to be taken prior to the rollover. If, however, the person separates from service at any time during the year of the rollover, the RMD will apply and must be taken prior to the rollover. So what Andy says is right, but I think John's question was, what if I do an in-service rollover and continue to work? Do I now have to take RMDs from those funds? If it's $1 million in a 401k and John is 75 years old, and because he's crossed over age 73 at this point, he has to take RMDs. I guess he would have fallen under the 72, whatever. He has the still working exception that he could use and not take any RMDs. But I think what John is asking is, if I roll over that $1 million to an IRA and I keep working, do I then have to take the RMD? Andy kind of answered a different question. If I retire during that time, do I have to take an RMD? And that's true. But it's also true that if you roll over those funds while you're still working, now that still working exception only applies to plan assets, not IRA assets. So you'll have to take a required minimum distribution from that new IRA that you transferred over, whether you retire or whether you keep working. So I'll bring that up to Andy, but I think he just missed the answer to that question. All right, let's move on to the markets. So there were some of the key items of the markets last week. Is existing home sales. Sales of previously owned homes were down 2.2% month over month and 16.6% year over year. The median price of a home sold was $406,700, a 1.9% gain from over a year ago. That's not a lot compared to what we've been seeing. And while the supply of homes for sale was down 14.6% year over year, so supply is going down, and we're still seeing small increases. It's going to be really interesting to see how this home issue kind of plays out, because we still have very low inventories. So even with rising mortgage, one would think that as mortgage rates rise, then the demand, of course, for homes is going to fall dramatically. That's kind of what we saw in the Great Recession. But because inventories are so low, we were still catching up. Builders couldn't build fast enough to cover inventories. Because inventories are so low, it may be that home prices at least hold the line for some time, even though interest rates are, last year, 30-year mortgage rates had touched 8%. We haven't seen that in quite some time. So it's going to, like I said, it's going to be interesting. I'm not going to make any predictions, but I'm going to be interested to see how this plays out. So that was existing home sales. Everybody talked about Nvidia last week. So they absolutely crushed their earnings, but the stock price came up and then dropped down. I think there was just some selling kind of on that rise from earnings, and then people were potentially taking some gains off the table. On the other hand, retailers like Macy's, Dick's Sporting Goods, and Foot Locker, they all warned on softening consumer spending. So that's an indication that we're starting to see that people are spending less and being strained by the economy. So Chairman Powell spoke at Jackson Hole last week, really didn't say a whole lot. The word uncertainty was repeated multiple times, while indicating further hikes were possible but not assured. He talked about the 2% target several times, and that progress has been made, but there's more work needed to be done. So likely, I think that we'll continue to see interest rate increases, Fed rate increases as we go on throughout this year, certainly, and into next year. So, and probably for the remainder, at least for the first half of 2024. What's coming up ahead this week? Today, just at 10 o'clock, I think it was, we had the JOLTS, which is the Job Openings and Labor Turnover Survey. So I'll have the results of that next week for you. The PCE Index, which is the Personal Income and Outlays Report from the PCE Index from the is that a Department of Labor? I'm not sure if that's a Department of Labor report. I know the JOLTS is a Department of Labor report, but this is the Fed's favorite gauge of inflation. and it's been sticky at the core level, and investors will certainly be watching this closely. Friday, we have a labor report, and then Friday, we also have ISM manufacturing. So that's what's kind of what happened last week and what's coming ahead. Let's talk about what happened in the markets last week. So the Dow Jones Industrial Average was down about 0.42%, still up over 5% for the year. And then year over year is 5.41. The S&P 500 was up slightly at 0.84%, still up almost 16% for the year. The NASDAQ was up 2.27% for the week. I think I said the S&P 500 was up 0.84% for the year. That's not right. It was for the week. Almost 16% for the year. Just 6.7% year over year. The NASDAQ was at 2.27, up 2.27 at 30.59% for the year. And it was really mixed across the board for the rest of the world. Emerging markets were up. More established markets were down. So that's not uncommon. The bond market was up a bit, 0.28%. Still year to date, just 0.41% gain. And that's on the mid-range, like the 7 to 9, maybe 7 to 11 year bonds. That's where most people invest their money. Short-term bonds, we're going to talk about that a little bit. They were down 0.0% last week, still up 1.56 for the year. And this yield curve is still inverted, which means you get more interest for shorter term bonds than you do for longer term bonds, but the longer range is starting to increase. The 10-year Treasury was at, you're going to make a liar out of me. It's still at 4.25, 4.24 at the end of the week. And this must be wrong. 4.25 the week before. At the year end, it was 3.87. Let's see. Now, I think the 10-year was actually up more than that last week, but that's okay. Goldman Sachs enters our discussion again today. They were talking about the changes in the 30-year U.S. Treasury. And they write, I'll just read it to you, have been driven by an improved growth outlook and expectations of tighter policy. Sticky inflation may sustain higher levels of yields, though currency weakness in China and Japan, two major holders of U.S. Treasuries, should have a temporary effect if central banks support their currencies. We believe repricing from temporary spillovers may be modest, while the trajectory of U.S. growth remains the main driver of upper pressure on long-end rates. So what does that mean? They're basically saying, well, we see some adjustments on pricing currently because of some of the risks of major stakeholders in U.S. Treasuries. We expect to see that the long end of the curve will continue to increase. I hope that makes sense. BlackRock, boy, is still on vacation. So it's really interesting to me. And I scoured my inbox. I think I told you last week, I scoured my inbox. I have got a segmented inbox just for preparing for our weekly webinar. And then they first come through my regular inbox. So I've been keeping a keen eye out for BlackRock. And they did deliver a report. I guess it was yesterday or maybe Friday, but they were only talking about the bond market in July. So I read through it and I said, well, maybe this is just a nice recap, but it really didn't have anything. So I don't know what's going on at BlackRock. They must just have a firm-wide holiday. Don't know. But the Wall Street Journal was talking about Germany's economy is sliding into stagflation. A reliance on manufacturing and world trade has made Europe's biggest economy particularly vulnerable to recent global turbulence, they write. Supply chain disruptions, surging energy prices, and the rise in inflation and interest rates. Now will be the world's only major economy to contract in 2023. A fractured political class is struggling for answers to the long-term headaches and short-term crisis, leading to growing concern. They also talked about China. So this had to do with China focus. Their focus is on, or that investors are focusing on value investing in China rather than growth investing. So undervalued positions, undervalued companies they think would do well. That's not my read, and that's not my recommendation. But I'm just giving you a report of what's going on per the Wall Street Journal around the world. Riverfront had some information again. So they talked about money markets have seen record inflows. We all know that. However, short-term investments carry reinvestment risks in our view. I think I mentioned it last week, but I'll mention it again. I had a client who said, well, if we're getting nearly 5% in short-term treasuries and money markets, why don't we just stay there? The reason we can't just stay there and we should not over allocate into that position unless you're using it for very short-term funding, maybe for the next 18 months or so, you run the risk of what we call reinvestment risk. At some point, the yields, the interest that we get off of these short-term instruments like money markets and treasuries, short-term treasuries, will normalize, and we won't be able to reinvest that money into anything with an appropriate yield, right? Or to get the growth that we need. So that's something you always have to pay attention to. They wrote about Taylor Swift, Riverfront. They said there are only two things hotter than this summer's record temperatures. That's Taylor Swift tickets and the demand for short-term investments. The latter should come as no surprise, given that investors have been starved for yield for over a decade. That is very true. So we've been looking at very, very low rates in money markets and short-term debt instruments. So this gets exciting when you see 4 or 5% in these short-term, pretty liquid issues. CDs and money markets seem compelling. T-bills, CDs, and money markets seem compelling, especially after 2022's losses in the stock and bond markets. But they go on to talk about the reinvestment risk. They go on to write, while there is little long-term harm in splurging on the summer's hottest concert, the same cannot be said for abandoning a well-constructed investment plan or delaying the start of it. And they talk about that reinvestment risk where if you just focus on, as I said, those short-term instruments, at some point you're not going to be able to replace those 4 or 5% as interest rates come back down and normalize. So what's the answer to all this? As I always say, that your plan should drive your investment decisions. When we go through our onboarding with clients and on a periodic basis, we send out a risk questionnaire. And that risk questionnaire gives us a risk score. And it's from 1 to 99, 1 being the most conservative, 99 being the most aggressive. And clients land somewhere on that scale, either very, very conservative, very aggressive, or somewhere in between. And I always tell people this gives us a baseline for investment decisions for you, or it's really not even scratch that. It gives us a baseline for how you feel about your investments, but it drives almost nothing about our investment decisions. Our investment decisions are based on your plan, and that's how it should be. And it has to be a meaningful, thorough plan. It can't just be that you tell your financial planner that you spend $80,000 a year and that's what they plug into their program and run these calculations on what you're going to need, because very, very, very few times have I seen somebody who comes in and said, this is what we spend. And that is actually the true number. There's many things that aren't considered in that projected expenditures. And yes, that's even for you folks who are engineers who have it all laid out in a spreadsheet and you've been tracking it for 30 years. Time and time again, there's often, almost always, something that is not being considered. So the answer, of course, is asset allocation. You have to have good asset allocation, good components within your investment strategies. You should have some level of principal protection. The studies all show a third of your assets should be invested into something that has principal protection. Account segmentation. Account segmentation divides out your investments depending on when you're going to need them over your timeline. Much more conservative in the beginning of your use of those funds, in the beginning of your retirement, for example. It can be much more aggressive as you go out on that timeline. So it gives us the ability, I use the terms, eliminate the worry about where your funds are coming from if the market drops off, and help you get the returns that you need later in life. So that's the answer to all this confusion and what's going on and uncertainty is simply asset allocation, principal protection, account segmentation, and investment decisions driven by a plan. And if you can throw guaranteed income in there, if you need income in your retirement, which everybody does, then that's very helpful as well. So let me switch over to our whiteboard and we are going to talk about Roth. Whoa, what happened there? We are going to talk about Roth conversions. So I'm shifting over here. This pause is a shift over to my Financial 15. So let me come here. You should now see my whiteboard. Now it is time for our Financial 15. And this is part 2 of our discussion about common Roth questions. And we're talking about Roth conversions. So you remember, I keep this all on the same whiteboard like I did last time. Last time we talked about contributions. And if you didn't see this video, and in fact, if you're just joining us for this Financial 15 on YouTube and we're talking about Roth conversions, then you're going to want to go back and potentially look at part one, Roth contributions, but you're certainly going to want to hit subscribe, like, and notifications so that you get the notifications when these videos come out. But this is going to be a 3-part series. We talked about contributions. You can see we talked about all these questions. And now this week, we're going to talk about conversions, and we're going to get through as many of these common questions as possible. They just kept coming. So the first one is really, what is a Roth conversion? Well, a Roth conversion is an allowance by the IRS that allows for a distribution from a traditional IRA to a Roth IRA without really any restriction. So they allow you to distribute funds from a traditional IRA and redeposit them into a Roth IRA. So I know I said no restrictions, but there are certainly consequences, right? So the consequences of that are tax and some other things that we're going to talk about. But a conversion is distributing money from a traditional IRA and redepositing that into a Roth IRA, or distributing money from a Roth retirement plan and redepositing. I did it again. Distributing money from a traditional retirement plan and redepositing that into a Roth retirement plan. So that is a Roth conversion. Very simply, you're converting the money from a traditional, forever taxed, as my mentor Ed Slott likes to say, to never taxed, as he says, and I say never taxed again, because once you pay the tax, you never pay tax again. And that is the benefit. That's your next question. So we talked about what is a Roth conversion. It's not a rollover. It's not a contribution. It's a conversion, taking that money, moving it from the traditional IRA to the Roth IRA. We're just going to stick with IRAs in this discussion. We've talked about retirement plans before, so I don't keep getting confused. So that's a Roth conversion. If we want to look at the buckets, you've got tax deferred. Well, let's make them all. You've got taxable. You've got tax deferred. And now you have tax advantaged or tax free. And here today, we're talking about Roth. It's simply taking money from this tax deferred bucket and IRA as an example, and converting that now, whatever dollar amount works for you, to a Roth. Now that dollar amount that you convert lives in the Roth IRA. Well, why would you want to do that? What's the benefit of that? Because you decide what tax rate you're going to pay during this conversion. So when you cross this bridge, think of that as a bridge, the toll is tax. And yes, you get to decide what tax rate you're going to pay. And we talk about that down here, so I'm going to save that discussion for there. But the benefit is that once you pay that tax, any distribution that comes out of here now is tax-free. There are also no RMDs from a Roth IRA. So you get to decide exactly how much you take out of that Roth IRA. Whereas we talk a lot about RMDs on this weekly webinar, and all the trouble people run into RMDs and all the confusion they have with RMDs, because currently at age 73, the IRS tells you exactly how much you have to take out of this tax deferred bucket. Each account has a requirement, and you don't get to decide. It used to be a 50% penalty of what you should have taken. Now it's either 25% or 10%, depending on how fast you act. But still, there's a penalty. And so if you're at age 73, if the IRS says that you need to take $100,000 out of your IRA, well, you must take $100,000 out of that IRA or pay tax and pay tax. If you don't, you pay penalty. There are some things that you can do with charitable contributions, but we've done a video about that. But what if you only need 50? What if you only need $50,000 out of your IRA? The IRS doesn't care. They say, we don't care. We need you to take 100 and you're going to pay tax. And if you follow us, you certainly are probably in the mindset that taxes are going to be higher in the future than they are today. And you'll be paying the, tax rate on that forced distribution. And we believe that taxes for your average middle-class American will be in the 40 to 45% effective tax rate beginning about 2030. So if you can pay less tax on this bridge, on this conversion, say at a 22 or 24% That's a 4% tax rate. That might be better for you, of course, than 40 to 45%. So as Ed Slott says, never taxed. As I say, never taxed again. You pay your tax. You choose the tax rate you're going to pay. You do that conversion. And now any distributions that come out of here are 0%. You pay no tax as long as you meet the requirements of the 5-year rule. We'll talk about that later in our next video. So any distributions that come out of here are 0 tax. There are no RMDs. No RMDs for you, no RMDs for your heirs, except for your heirs would fall under the 10-year rule. So I really like the comment Ed made at our speaking event here in Newtown, Pennsylvania in May. He said, what you're doing is you're locking in your tax rate for your life plus 10 years. There's also no tax for your heirs, right, during that time. So, or even at that distribution, that end of that 10 years, there's no tax. So you truly are locking in your tax rate for that time. And then, of course, any growth that you have is tax-free. So it's not only just the tax rate on the amount that you're converting, but also you don't pay any tax on that growth. So if you have $1 million over here, $1 million, and you over time probably convert it to Roth, and now your $1 million is over here, well, that's certainly you've locked in that tax rate. But let's just say it grows by another $1 million, and now you have $2 million in your Roth. Well, you don't pay tax on that either. People ask me that. I should have added that, so I'll just add it verbally. People say, well, don't I pay tax on growth? I had a very well-respected attorney say that to me. Well, they're going to pay tax on the growth. No, that's not how it works. As long as you meet the requirements of the 5-year rule, you won't pay tax on that growth. So it's not only locking in the tax rate that you have on the conversion amount, but then you're also saving yourself future tax on that growth. So I hope that makes sense. So that's what is the benefit of a Roth conversion. So you're converting that money from forever taxed to never taxed again. And then the growth really is never taxed. So Ed's right about that one. So the next question, can I convert my traditional IRA to a Roth IRA? Well, the short answer is yes, right? Anyone who has a traditional IRA or traditional 401k, I promised I wasn't going to talk about that, but I just have to, a traditional retirement plan, you can convert it. Now, with a retirement plan, you have to have a retirement plan to convert it in. They have to allow you to convert it. So this is why I don't like to talk about that. That's very specific. But if you have a traditional IRA, you can certainly convert it to a Roth IRA. And one of the things that sparked this conversation was someone said, well, I can't do a conversion because I make too much money. Well, there is no limit on how much money you can make to do a conversion. What this person was talking about was the phase-out levels. I'm going to go back to section 1 for a second. This person was talking about these phase-out levels for contributions. And this gets confused not just by individual investors, but also by professionals. I've had CPAs say this. Well, they can't do a conversion because they make too much money. That's not true. Only contributions are affected by the phase-out levels. That does not apply to conversions. You see, that refers to contributions. So you can scrap that. If you make $1 million a year or $10 million a year or $1,000 a year, you can do conversions. So can you convert a traditional IRA to a Roth IRA? As long as you have one of each, you can do it. As long as you have a traditional IRA and as long as you have a Roth IRA, you can do a conversion. And all you have to do is establish a Roth IRA. It's very, very simple to do. So then the next question is, how much can I convert? How much? What's that dollar amount? Well, you can convert as much or as little as you'd like. In this example of the $1 million, this person could convert their entire $1 million in 1 year, be done with it, and never have to worry about it again. That's probably not the recommendation we would make. We would probably say consider splitting that over time, those conversions, so that you choose the tax rate that you're going to pay for those conversions over time. But you can, if you had $1 billion in there and you wanted to convert it all in 1 year, you could do that. So you'll hear me say there are no guardrails on this. The IRS says do as little or as much as you'd like. We just want the tax on it. We want the tax on it now because we don't see the future. The Congress only sees and the IRS only sees a very, very limited period of time. They want their tax money now. So they're not concerned about what it grows to. They're not concerned about that. They want their tax money now. So they encourage Roth conversions by saying, do what you want. No guardrails. So can you convert to a Roth? How much can you convert? The answer is as much or as little as you want. Really, really simple. Now, this one's not so simple. When can I convert to a Roth? Remember the confusion about contributions with this phase out? Right? How much can I convert? No, that doesn't apply. The phase outs don't apply. We also hear a lot of questions about, well, when can I convert to my Roth? You can at any time throughout the year convert to your Roth IRA. It's considered being converted as of January 1. You cannot do a previous year conversion. So technically, you have to do your Roth conversion by 12/31, December 31st of the year that you want that tax year to apply for. It's 2023. We only have a few more years before the end of the Tax Cuts and Jobs Act, and we only have a few more years beyond that to where we hit this point of no return, where we're going to see significant increases in tax rates. This 40 to 45% effective tax rate. That's why I don't think anyone should wait on this strategy as long as it works for you. But if you want a conversion to be in place and effective for 2023, you cannot wait until the tax filing deadline in 2024 like you can for a contribution. Other than just general world peace and everybody having everything they need, if there's one thing I could wish for Congress, it would be to allow us to do Roth conversions by this tax filing deadline, but they don't want us to do that. It would be better for them because more people would do more in Roth conversions once they have their capital gains assessed and their income assessed. They would feel more comfortable about doing more conversions. I'm convinced about that. But your filing deadline, or your conversion deadline is technically December 31st, but do not wait until December 31st because the people that hold our money, what we refer to as custodians, often have deadlines that are prior to December 31st. We've seen it as early as November 1st. So if you think that you want to get a Roth conversion done by 12/31, you better start thinking about it now. So we typically start our conversion process for end of year conversions by September 1. We just actually started we've been having conversations all year. Many, many people we convert throughout the year, but those who have to wait till the end of the year, we start having that conversation. We start having the plans drawn up September 1st. We had the conversations a long time ago. So when can I convert my Roth? It must be done by 12/31, but don't wait until 12/31. All right. Will I pay tax on my Roth conversion? Well, what do you think? Of course, yes, you are going to pay tax on that Roth conversion. Now, if you manage it where your conversion amount is below your standard deduction and you don't really pay tax on it, well, that's wonderful. But technically, yes, you're paying tax on that. And now the next question is, how much tax will I pay? Well, that depends. So let's go over to our handy dandy tax chart here. And again, you can download this tax chart by going to attleborowealth.com. I'm just going to pull that in and show it to you here. Excuse me one second. Oh, boy. All right, give me a minute. There it is. Let me just share with you where you can grab this information. So you go to attleborowealth.com and you go to education and resources. Do this drop down and you'll go to the slot corner. So these are Ed Slott's charts that I use all the time. So I want to give Ed his credit, and you'll come up to a page that says the slot corner. There's some information about the Master and Lead Advisor group that I'm part of. And then at the bottom of this is download free tax planning, and you can just download that material and use it for your benefit. All right. You can rewind that if you need to, But this is where I grab this tax chart, and this is for 2023. So how much tax will I pay? Well, this is how you determine. See these marginal tax rates here. You start at 10%. We're going to focus on married filing jointly, but I want you to focus. I want you, if you're a single filer, pay attention over here to the single rates. So from $0 to $22,000 in taxable income. So that's after any deductions you have. Even, that may be the standard deduction, and you can grab the standard deduction over here. If you're married filing jointly, that's $27,700. If you're a single filer, it's $13,850. Head of household to $20,800. That just means that if you have deductions that are not greater than that and via itemization, then at least you get the standard deduction. And if you're married and over 65 or blind, you get another $1,500 per, and then single as $1,850. And if you're over 65 and blind, you get a little bit more. So let's just use these as your taxable amount. So let's just say you're a married couple. You make $127,700. Then you would land right here, right? 22%. You would pay the first $22,000 at 10%, your second $22,001 to $89,450 at 12%, and then you would pay that last $11,000 at 22%. So you land somewhere in the middle of this 22% bracket. So the first thing you might say is, all right, well, I have $90,000 left to go to the top of the 22% bracket. You might also want to get aggressive in your allocations and say, if I push it to the top of the 24, I can take that all the way up to $364,000. So your answer might be, I want to convert, if you have $1 million, I want to convert $264,000. This is not a recommendation. This is an example. You might want to make this amount that you convert, $264,000, to take you to the top of the 24% bracket. And then you might want to adjust it for the following year. So how much are you going to pay? How much tax are you going to pay? You're going to pay 22% on the difference of $100,000 to the $90,750. If you're married filing jointly, remember over here, the single filers are different. And then from the $190,751 to the $364,000 that's left in there, right? So that would be $164,200. Then you would pay 24% on that, just those dollars. So your blended rate would be between the 22 and 24%. So you might end up maybe at a 23% effective tax rate just on that conversion. But that's how you figure out how much tax you're going to pay. And you can see that you get to decide how much tax you're going to pay, because you might say, all right, I agree with that. I'm going to move $264,000. You might say, I'm only going to move $100,000 because I don't want to pay more than, or in this case, $96,000, because I don't want to pay more than 22%. That's your choice. And if that works for you to get that money transferred over time, this is taxable, tax deferred, this is tax-free or tax advantaged, then that's fine. You get to choose. The IRS doesn't say, well, if you're going to do a conversion, you must do this. You get to choose. So I hope that's helpful. So how much tax do I pay? It's different for everybody. It's different for every conversion. You got to do the calculation. When will I pay tax on my Roth conversion? Well, there's two different options fundamentally. The first is, and these are not in any benefit priority order, right? So is withholding. That is, if you're using the $100,000 example and you're going from tax deferred to tax free and it's $100,000, and let's say your blended tax rate is 20%, you can say, you know what? During that conversion process, I'm going to send $20,000 to the IRS via withholding. $80,000 is going to end up over here in the Roth IRA. I'll never pay tax on that money again. I'll never pay tax on any growth. I'm good with that, as long as you meet the 5-year rules. And this $20,000 goes right to the IRS. And any withholding is considered to be paid throughout the year, so you don't have a timing issue. The problem, of course, is that there's nothing wrong with withholding the amount of conversion. You have to gross up. I mean, you're going to have to take out more than you would have if you paid it out of pocket or out of savings. But we'll have to do a webinar on that one. How to calculate withholding. But you don't have to worry about the timing on it. It's done. And it's easy. A lot of people just feel comfort in this because they're used to that withholding from their paycheck. It just just like when you get your paycheck and you earn $1,000 and the IRS, keeps $200 and you get the rest of it. That's withholding. The other is, that's the wrong one. So withholding. The other is you can pay the earnings, pay it from earnings. So I make $100,000 a year. I'm just going to pay that tax out of that, out of those earnings, or maybe you make $500,000 a year and you pay the tax on the earnings. I don't know. Or you can pay it out of the taxable bucket. So if you've got, $500,000 saved in your taxable bucket. So that's anything that's not an IRA, your mutual funds, stocks, individual bonds, money market, CDs, savings. And you say, you know what? I'm just going to pay that $20,000 from this taxable bucket. Well, that's fine too, but you certainly don't want to wait until the following. Say if you did a Roth conversion today, August 29th, 2023, you don't want to wait until April 15th or whatever the tax filing deadline is in 2024, because you're likely to receive a penalty by the IRS for waiting that long. What you're going to want to do is make an estimated tax payment or pay that tax payment the following quarter. So in this example, that would be September 15th. You'd want to make that tax payment just to make sure that you don't run afoul of the IRS on that tax payment. So timing is very important. This is why if you look at my video about developing your retirement team, I talk about you want to have a certified financial planner on your team, someone who specializes in this kind of work, tax efficient strategies, IRA distribution, and retirement plan distribution strategies. You want a qualified CPA on your team to address questions like the one I just discussed about timing of tax payments. And then you want a good attorney. And folks, if you're in your 50s or above, you want that good attorney to be not only a state attorney, but an elder law attorney, in my opinion. So you could either do withholding or pay earnings from a taxable account. Next question here. Will my Roth conversion affect my ability to do Roth contributions? The answer is no. And I get this question several times a year. Many times it's from it's a response from, well, my accountant told me because I did this conversion, I can't do a contribution this year because now I'm above this. Remember, if you make too much money, and this is based on modified adjusted gross income, with an asterisk, if you make, let me erase this. Hang on. If you make what the IRS refers to as too much money, then you can't make a contribution. If you're married filing joint, then that's $218,000, $228,000. So you say, geez, I only made $60,000, but I converted $200,000 or $300,000. And now my accountant tells me I can't make a contribution because of this conversion. Well, your accountant is completely wrong. And I would suggest that you find a new accountant because I had this, well, I've had it many times, but it was sometime this year. There was a person who said, my accountant just said he can't point to the rule that says, you might be right, but the accountant can't find the IRS rule that says that the Roth conversions are excluded from that calculation because they are. Roth conversions do not count against the modified adjusted gross income calculation for Roth contributions. So let me just say that one more time. Roth conversions do not count in the calculation of modified adjusted gross income for Roth contributions. So you could convert $1 million a year and still make your contribution if your normal income falls below, without the conversions, falls below the phase-out levels. So, it wasn't just the one time, but I've heard people say, I can't point to anything in the IRS code. Well, this is, I put it here for us. It is 590A. Where'd it go? Where's my link? Oh, publication 590A. It's right there. So here's an excerpt from 590A. And it's really simple. So again, you can look this up, 590A, just search IRS 590A, and you'll see, enter your adjusted gross income from your 1040. This is a worksheet to determine, if you're triggering that phase out. Modified adjusted gross income for Roth IRA purposes. Enter your adjusted gross income from your 1040, et cetera, line 11. Enter any income resulting from the conversion of an IRA to a Roth IRA. So you put, 50,000 in here if that's your thing. So you put 200,000 in here. You might say, well, that's going to take me over. Now it says subtract line 2 from line 1. So that gives us the amount that you subtract this line 2 from line 1. Enter any traditional income deduction from, and then it continues. So, and up here in this notification, you'll see it reads modified adjusted gross income. Your modified adjusted gross income for Roth IRA purposes is your adjusted gross income is shown on the return with some adjustments. Use worksheet 2.1, that's the one below, to determine your modified adjusted gross income. It goes on to give a caution. Don't subtract conversion income when figuring your other AGI-based phase-outs and taxable income, such as your deduction for medical and dental expenses. Subtract them from AGI only for the purposes of figuring out your modified adjusted gross income for Roth IRA purposes. So I don't know how to be any clearer. The IRS code is very clear. This publication walks you through. So don't get caught up in that. That's a really common question. The next one, and we're getting tight on time. Am I too old or too young? You might be. You might be. Less about being too old than it is too young. Because if you're, think about the firefighter. He's 47. Let's just say he doesn't have the ability to draw. He's got the ability to draw out of his retirement plan under age 59 and a half, and even under age 50 because of his circumstances where he works. But if you're 47 or 50 years old, let's just say, and you wanted to roll over your 401k because they don't allow Roth contributions, they don't allow Roth conversions, roll it into an IRA, and then start doing Roth conversions, you're probably restricted if you're still working there. If it's a previous employer, you can roll over your funds. You might be too young because of this 59 and a half rule. If you're over 59 and a half, most plans allow you to roll those funds into a traditional IRA, and then you can convert however you'd like into a Roth. But if you're under 59 and a half, it's much, much more challenging. Am I too old? Oh, by the way, and you also can't do withholding on, even if you have $1 million in your traditional IRA and you're under 59 and a half and you want to roll it into a Roth IRA. This is something I see people get jammed up on all the time. They say, well, I'll just do that withholding that you talked about. I'll send $20,000 to the IRS via withholding. Well, that's considered an early distribution, not the Roth conversion, but the withholding is considered an early distribution, and you'll be penalized 10% on the amount that you withheld for tax. That stinks. So you could be too young in that regard. Could you be too old? We like to say, and I believe this, that if you think you're going to be here another 10 years on this planet, it probably makes sense for you to consider Roth conversions, but it should be looked at for sure. So you have to do a comparison. We always do. When we're looking at bringing on a new client, we want to make sure that we're going to be impactful. So, and that all this work, this crazy, busy, detailed work about tax efficient planning is going to be impactful and make a difference in people's lives. So we like to do that side-by-side comparison you've heard me tell you about, and that's where we see sometimes millions of dollars of difference, often millions of dollars of difference in the impact of people's own lives and certainly the lives of their loved ones. I get this. What is my break even? I convert $100,000 from my traditional IRA to my Roth IRA. What is my break even? Your break even is zero. There is no break even point. You'd have to assume that you don't pay tax at all on those distributions from your traditional IRA. Your break even rates of return is absolutely zero when you convert to a Roth IRA. So I have a really detailed video about that. I'm not going to go through right now, but that's a good question and one I get, but it doesn't matter. There is no break-even point. Other considerations, it does drive up your modified adjusted gross income. So as I said, I'm talking about Roth conversions. They drive up your modified adjusted gross income. So there are many things that are affected by that, not Roth contributions, as you just heard and learned, but your IRMA, income-related monthly adjustment amounts. If you are over 65 and receiving Medicare benefits, Then you probably know all about IRMA. IRMA is really a phantom tax on your benefits. They take they charge you an additional amount, which can be significant for your Medicare premiums if you earn over certain thresholds. So we should probably, I think I've done a webinar on that, but if not, we should do one. So I'm gonna asterisk that. Taxation on your Social Security. So that modified adjusted gross income during your conversion periods will cause likely your Social Security to be taxed. These are typically temporary, and we have calculators that show the value of doing the Roth conversions, tax savings, the IRMA savings over time. Usually it works out when we share that. Even though you pay more IRMA in the beginning of your conversion, that it works out in the end. Same with taxation on Social Security. And then you have other tax credits. So it could erase other tax credits. One we're watching out on now is your EV credits, electric vehicles. So you can get up to $7,500 off the purchase of an electronic vehicle. But if you make over certain thresholds, a modified adjusted gross income, then you don't get that. And certainly Roth conversions will trigger that. So, okay, that's a lot of information. You see, there's a lot of questions. It's 11:03. We went a little longer than usual, but I appreciate you holding on. I hope you all have a great week. Remember, there is no webinar next week. If you have questions, you want to reach out to us or schedule time, you can reach us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you want to go to where those charts were, you can go to attleborowealth.com. We have lots of videos. If you want to watch our previous weekly webinars, you can go through there, explore some of the topics that we go through. If you want to look at the financial 15s, if you have smaller periods of time, you don't want to sit through what now is more like an hour and 4-minute webinar, then you can look at the financial 15s that we've started to divide up into smaller segments of time, maybe 8 to 10 minutes, and you can find them on our YouTube channel. Just search Attleboro Wealth on our Attleboro Wealth Management on YouTube, and you'll find it. Folks, that's it for this week. Have a great holiday. Great Labor Day. Have a great rest of the week, and reach out to us if you need us. Take care.